I'm a real estate investor, and I'm going to be reacting to Nick's video here from Reventure Consulting about how the housing markets are still declining. Be sure to hit that subscribe button and that notification bell so we can keep watching these videos together. Let's get at it. I have not seen this video yet. Let's watch it together.
Robert Shiller, the person who predicted the 2007 housing crash before anyone else, has just come out and said that now is a bad time to buy a house and the prices will continue to drop. He says that house prices are still very high,
as in the Shiller index,
and to hold off on buying as the U.S. economy will keep struggling. He also thinks that the downturn is going to continue and it's going to get cheaper after another 6 months. And the whole reason Robert Shiller, the godfather of modern housing economics, is saying this is because he's looking at the data. Particularly, he's looking at inflation-adjusted home prices in America, which have...
Hold on. Look at that. Look at that. Do you see that? Do you see that? Take a look. Look at that. The 2006 peak, and the 2022 peak. This is higher. This was the top right before the great financial crisis and the housing market went down. But we have better qualified buyers now. That's true, but holy shite.
Come down over the last 8 to 9 months from their peak.
I didn't know it was that high. I didn't know it was that different, right? We're looking at 171 to 197. Not thousands. It's just a measure. It's a measure, quantifiable measure. Not 197,000, not 171,000. So think of it as, in other words, it is about almost 20% higher than it was at the peak in 2006.
But they are still way too high. And in fact, inflation-adjusted prices today are even higher than they were at the 2006 peak of the previous bubble, which was the biggest crash of all time. Additionally, inflation-adjusted prices today are way, way higher.
And look at where we are at. Look at where we are at compared to this drop that happened here. We may not see a big drop like that, but look, I mean, when you look at it like that, we've barely come down. We haven't even come down to, we're at 181. Compared to 171, like it just looks like there could be further down
than they were in the 1989 peak, 1979 peak, and the 1964 peak.
I mean, look at those. We were at 106, went down to 94. So that's about a, what is that? 15, about a 12, 13% drop, about a 12% drop. And here we went from 114 down to 98. So that's about a 15% drop or so.
And so if you're a home buyer out there who's struggling right now, you're wondering why prices are still so high, why they're not going down faster, understand this is normal. Housing downturns take years and years and years to play out. The average housing crash takes 5 years from peak to trough. We are still in year 1 of that housing downturn, so there's more runway to go in terms of declines. And the declines are likely to be steepest in the most overvalued housing markets, particularly the areas in red on this map, where the relationship of home value to income is just way out of whack. I mean, take a look at California. The typical home value of $720,000 is 8 times the median household income. Wow. Compare that to a place like Iowa, where the typical home value is only 2.8 times median household income. Clearly, California is going to have a bigger housing crash than Iowa because it's income that fundamentally drives the U.S. housing market. How much money people make ultimately determines the type of down payment they can afford and how much mortgage interest they can afford to pay on an ongoing basis. And so if prices go way above the level of incomes, eventually they're going to have to come back down. Now, another option is that income and wages grow to meet the higher price levels. And that's something that actually occurred in the 1970s, in the great inflation of the 1970s. One of the reasons the housing market did so well back then was because Americans were making lots and lots of money and their income growth was huge, registering anywhere from 7 to 10% per year for a decade. And all of that income growth led to huge levels of personal savings. I mean, take a look at this data, folks. In the 70s, the personal savings rate in America, the average amount that families were able to save after spending money was around 10 to 12 to 13%. So people had a lot of money back then to spend on housing, to spend on rent. But then fast forward to today where
what's really interesting about that, let me rewind that. Right here is when the petrodollar came into existence right here in 1974. That's when Kissinger from America went over to Saudi Arabia, where it was a very tumultuous area, war-stricken area, and said, hey, Saudi Arabia, if you price your oil in US dollars, you will get the full backing and protection of the US government. They said, sign me up. Interesting to see this go down so much after the petrodollar. We went off the gold standard in 71. 3 years later, it became the petrodollar. It's interesting to me that savings rates have went down so much since then. Let's get back to the video. Be sure to hit the subscribe and notification. Let's keep watching some videos together.
On housing, to spend on rent. But then fast forward to today, where the personal savings rate is anywhere from 3% to 4%, near the lowest level.
This big, where was the bottom here? I don't see the year, but this is obviously COVID, when a bunch of money got printed, everyone got handed a bunch of money.
Of all time, a signal that Americans don't have enough money to support the housing market this time around. And really, that's the dirty little secret that realtors and real estate investors and a lot of the mainstream media don't want you to know as a home buyer. They don't want you to know that it's
very true.
Income and savings that fundamentally dictate where the housing market goes. And they don't want you to know that there's not enough of it to keep the housing market supported. So that's why you see so many false narratives, so much propaganda being spun right now about how the housing market is recovering, about how home prices are going to keep going up. It's a bunch of crap, everyone, because income is what determines home prices in the long run, and the incomes aren't there, especially in light of this
housing affordability index, which is basically the monthly payment of a house compared to what someone earns per month, the median income and the median housing price. And then you couple that with inflation, with interest rate, that'll give you your median monthly payment. Compare that to your median salary. Maybe I should look at you when I say this. The median salary compared to the median mortgage payment for the median priced house, right? That's what gives us the housing affordability index. It is as high as it has ever been. And that can't be ignored. It can't be ignored. It just cannot be ignored. I hope that makes sense. Let's get back to the video.
This recession that's unfolding in 2023, I mean, the white collar layoffs are getting even more severe with each passing day. And additionally, the wage growth in America seems to be stagnating. One of my favorite things to do to just understand this, to get a sense of what a regular American is feeling and dealing with, is to just go on Indeed, the job search website, and see the type of jobs that are available. Right now, if you're in Miami, here are the full-time jobs you can get. You can become a medical assistant at a cancer institute and make $18 to $23 an hour, which would be about $40,000 a year. Or you become a claims specialist for the Social Security Administration and make $45,000 a year. Or you could become an insurance collection rep and make $16 to $19 an hour full time. And so, yeah, most of the jobs on Indeed in Miami full time are hourly, and would get you anywhere from $40,000 to $50,000 a year if you were to work them full time. And that's just not enough money in a metro where the typical rent for an apartment is $2,800 a month. You can see here that a couple of years ago it was around $1,800 a month to rent an apartment in Miami. Now it's $2,800 a month.
What? It went, what year is this? God damn, that went up fast. I mean, it went up in a matter of, what is this? Wow. 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 It was 1667. It was 2020 was 1862. And it shot up $1,000. It shot up over 50%. Wow.
Month, and the incomes have just not kept pace, with the typical family in Miami now needing to spend 50% of their median income to afford rent. And so, folks, none of this is sustainable. I mean, the people who are holding out thinking it is, I mean, what are you looking at? What data are you looking at that says to you that it's a good idea to buy a house right now, or that it's a good idea to be an investor?
What's interesting, I live in the Seattle area, which is one of the more run-up housing markets in the country. People are still overpaying for houses. What I've noticed is people are not overpaying. They're paying above ask. There's bidding wars going on in houses in the 4-bed, 3-bed, 4-bed, 2-bath in the high 3, low 400,000s. Those are getting bid up like crazy. I was looking at some houses. We were taking a client out we were looking at a house that was $379, a 3-bed, 2-bath. Not the greatest house in an okay area. And in that price range, it ended up going for $425. 425 went for 50,000 over, 50,000 over, which was about 15%, 16% over. And I'm like, they're paying a 7, 8, and maybe 9% interest rate. And I'm like, holy shit, we are in peak buying season, right? But it just tells me, it doesn't seem that the market has come to grips with what's really going on yet.
And try to rent out a property when the tenant
this just can't keep up forever. It just can't. Housing is the least affordable it has ever been by a decent margin now.
in your city are having to pay 40 to 50% of their income to afford the rent. Like, that's only going to end in one way. It's going to end,
like he was saying, only if wages, median income, goes up dramatically to keep pace. Because eventually you're at the tipping point, and we're well past the tipping point.
in evictions. It's going to end in defaults. And in fact, we're already seeing this occur. There's a big surge in evictions going on right now all across America because tons of tenants cannot afford the rent with how much the rent has gone up over the last 2 years. Data from Eviction Lab shows that in metros like Miami, the eviction levels are back up above pre-pandemic levels. Same thing in Las Vegas, where evictions are now up 81% from average. And these evictions are now leading to a big surge in vacant housing units and vacant apartments. If you go on Zillow, you're going to see a lot more vacant houses for rent. You're going to see, if you're looking at an apartment building, there's going to be a lot more selection for you if you're a renter in an apartment building. And this is causing rents now to start to go down across America, which is a big problem for landlords, because declining rents and increasing vacancy rates means they're not making as much money. They're starting to lose money from what they were making during the pandemic in a time period where interest rates are going up and a recession and layoffs are on the doorstep. So a lot of these real estate investors, they're going to get wiped out and flushed out as this recession and housing crash unfolds. But if you are a real estate investor, I think there are certain areas of America where you could buy and be more protected. If I were an investor, I would personally target housing markets with the highest cap rates. These would be the areas in red on this map. A lot of them in the Southeast, where the cap rates are around 8 to 9%. There's a bunch of markets in the Midwest where the cap rates are around 7 to 8%. Higher cap rates means you get more cash flow from day one from your rental property, which means you're less reliant in the long run on appreciation and rent growth to make your investment make sense. Additionally, those housing markets in the Southeast and Midwest are also much more affordable for local home buyers. So if you are an investor, you're not doing as much damage.
Houses in those areas didn't get run up like crazy the past few years. The coasts and some parts of the South, like Miami, Texas, parts of it got ran up pretty good. The Southwest and the West and the East Coast, not necessarily the Northeast, but the Midwest, the Northeast, and parts of the South didn't get run up like crazy, but the rest of everything did.
To people's home buying prospects if you buy in those cities compared to more expensive ones on the coast. If you're an investor or a home buyer and you want to access that data, you can go to www.reventureapp.com. This historical cap rate data for every metro in America going back 7 years. And really, folks, I got to say, my whole inspiration for Reventure app and bringing the data to you on the US housing market comes from Robert Shiller, the economist we talked about in the beginning of this video. The fact that he's saying hold off on buying a house is a huge deal. Robert Shiller literally laid the groundwork for understanding the housing market. Back in the late 1980s, he developed the first system for tracking home prices in America called the Case-Shiller Home Price Index. Additionally, he was the first one to call out the housing bubble in the mid-2000s. In 2004, he wrote a paper called "Is There a Bubble in the US Housing Market?" And the whole methodology he used to predict this bubble was the fact that home prices went way above income levels. You could see he had these graphs back in California and Massachusetts, which showed the bubbles there. But then he identified how Wisconsin wasn't a bubble because the relationship stayed stable. And that's the exact same methodology that I used in these videos.
With that said, I know people that bought homes in Wisconsin. So it's even that local dependent. Now, the Wisconsin area I'm talking about is on the outskirts of the Twin Cities, Minneapolis, Twin Cities area. It took them, they bought in 2006 at the top. It took them over 10 years to get back to the price they bought it at. But yes, overall, most Wisconsin probably did not.
Videos starting 2 years ago that allowed me to predict this housing bubble before anyone else. And it's the methodology that you guys have access to for free in the Reventure app. And just going back to this map of the value to income ratio, the most overvalued housing markets in America. I mean, let's just take a look at Florida. The value to income ratio in Miami right now is 6.7. The typical home value is 6.7 times the median household income. That's
higher than it was in 2007. Significantly.
Way above the long-term average of 4.5, which shows you it's a housing bubble. What's even more concerning is that the peak value to income ratio in 07 in Miami was 5.7. It was actually lower. Miami wasn't in as big of a bubble relative to income back in the mid-2000s, and then there was a big crash. So if you're a home buyer and investor looking at this graph in Miami today, I mean, how could anyone actually say it's a good idea to buy with a straight face? Same thing in a market like Phoenix, everyone. Value to income ratio today in Phoenix is 5.7x, which is way above the long-term average of 4.4 and is comparable to the peak.
Look at the size of this correction right here. Look at the size of this correction. Back from 06, 07. Look at the size that it went down over 50%, like 60%. Look at the size of that correction. It's all the way back up here again. Watch out.
It occurred in 06 in the last bubble.
And it took 6 years.
Crashed. So again, I'm seeing some people now say Phoenix is having a housing market recovery. It's a good idea to buy. No, I don't think so. Things still have a far way to fall. But not all cities are like this, everyone. Not all cities are going to have a big housing crash. In particular, like a lot of areas in the Midwest are just more fundamentally supported and aren't going to see prices go down as much. You know, if we look at Pittsburgh, for instance, the typical value to income ratio is 2.7, means it only takes 2.7 years of median income to afford the typical house in the metro. As well as down in pockets of the Southeast, like Little Rock, Arkansas, the typical home value is only 3.1 times the median household income. And so those markets are not going to crash as much. It doesn't mean they're not going to see prices go down. There's still going to be a correction, but it's not going to be like this major crash because quite simply, the local home buyers still have some money and are able to afford the prices. One thing I would encourage you all to do is to use Reventure app to actually see a list and a rank.
All right, that's the end of the video. So housing prices are kind of, depending where you're at, everything is market dependent, even city dependent, maybe even county dependent. But when we're talking about the West Coast, the Southeast, the South, like parts of the South, like say Texas, and then the Southwest, it's got a ways down to go because it just can't, like people can't buy it. Maybe investors will buy it. Well, maybe, but that's really bad for all of us. If the house prices stay there and then the only people that can buy it are investors and they just hold it forever and make all of us rent, which is their goal, which would be terrible for us. And the government should definitely do something about that because that is too much. That's a monopoly of housing. So they got to do something about that. So prices need to come down. They will come down. We are still in a bubble. We are. I agree with Nick so much. I'm in the real estate industry. I'm telling you, a lot of places are still in a bubble. And the fact that you may respond to this video and go, hey, houses in my area just went up. Well, your area may be different, but I would say that it shows a lot. Most places that's still going. Like I said, here in Seattle, which is in a bubble, no doubt about it. And there are still some houses that are going well above asking price. And that shows me that it hasn't really settled in and we are still in the first couple innings of this thing playing out. I hope you enjoyed this video. I always want to watch these videos with people when I watch it. That's what made me think about doing these reaction videos. Hit the subscribe button and the notification bell so we can watch more videos together. Thanks for spending the time. Have yourself a good day and be careful.